Let me throw a question your way. Imagine I said there's a business where 93% of participants lose money, the operator profits no matter the outcome, and people keep returning convinced that this time it'll work. Your first thought would probably be a casino, right? And to be fair, that comparison would actually be kind, because at least casinos are upfront. You already understand the odds are stacked against you. You know the house advantage is built in, and nobody seriously claims roulette is a long-term career. But what I'm about to show you today doesn't offer that same honesty. In fact, it's even worse than a casino. Before I dive in, a quick disclaimer. This video isn't quite like my usual content. If this is your first time here, I normally cover market updates, investing, and all the entertaining ways capitalism can quietly reshape your future while you're reheating dinner. But what we're talking about today is so accepted, so normalized, and so obviously predatory that ignoring it wasn't an option. Stick with me until the end, because once everything is laid out, I think you'll feel the same mix of surprise, frustration, and disbelief that I did. And if you enjoy this type of breakdown, tell me in the comments, and I'll make more. The finance world is packed with scams, and the one we're covering today is hiding right out in the open. I'm talking about proprietary trading, or what's more commonly sold as prop trading. And before the comments section lights up, I'm not referring to the Hollywood fantasy version of trading, where a hoodie-wearing genius turns 10K into a million while sipping espresso and murmuring alpha into a Bloomberg terminal. That scenario exists, but it's one in a million. What I'm talking about is the far more common version, the retail-facing version, the one built around challenges, profit targets, drawdown limits, and Discord servers filled with people posting screenshots of winning days right before they vanish forever. And if you think this is just some tiny niche in finance, think again. Prop trading has blown up in recent years, and videos just like this are a major reason why. These clips sell a fantasy on TikTok and have quietly turned prop trading into a $12 billion industry that's pulled in Gen Z and millennials alike. But here's the part they don't include in those TikToks. Only 7% of prop trading accounts ever make money. And out of that 7% who do end up profitable, the average return is around 4%. Pause on that for a second. Let's say you actually beat the odds. You stay disciplined, you're consistent, and you genuinely have an edge. You land in that tiny top few percent of traders earning a 4% return. At that point, the real question isn't how impressive that is, it's whether it was worth it at all. And the answer, overwhelmingly, is no. Because 4% doesn't just lag behind the S&P 500, it trails gold, real estate, and even United States Treasuries. In other words, you can be a prop trader, stress yourself out needing a hair transplant in Turkey, pay absurd fees, and spend years chasing consistency, or you can do basically nothing, take almost no risk, enjoy favorable tax treatment, and earn a similar return by simply buying U.S. Treasuries. A 4% return isn't impressive. It's barely keeping up with the risk-free benchmark. So if the odds are terrible, the returns are mediocre, and the alternatives are clearly better, why does anyone sign up for this? The answer is simple: social media. Spend 5 minutes scrolling the finance side of TikTok, and you'll see the same stories repeated over and over. A rented Lamborghini, a broccoli-haired teenager flashing cash, a P&L screenshot with zero context. They tell you anyone can do it. They say losses are just part of the process, and that failing only means you didn't want it badly enough. And the most troubling part is that the pitch works. What was almost non-existent just 5 years ago is now fully mainstream. So the real million-dollar question becomes, who's actually making money here? And spoiler alert, it's not the traders, it's the firms providing the so-called funding. Because here's how the model really works. A trader pays an upfront, non-refundable fee to try a trading challenge. In exchange, they're given what appears to be a 50K or 100K account. But it isn't real money. It's a paper trading account on a simulated platform. The trader starts trading. If they fail by hitting a drawdown limit, the firm keeps the original fee, resets the account, and moves on. If the trader passes, the firm may issue a payout where the trader receives a percentage of the simulated profits while the firm takes the rest. Here's the critical detail that's almost never mentioned. Those payouts don't come from market gains. They come from the pool of fees paid by the traders who failed. And this is the moment where everything starts to make sense. The entire prop firm model rests on a single statistical principle called gambler's ruin. The idea behind gambler's ruin is simple. In any game where a participant has limited capital and a non-positive expected value, it's statistically guaranteed they will eventually hit a losing streak and go broke. Not because they're dumb, not because they're reckless, but because the math is against them, and time is working in the background. Let me make this even clearer with a basic example. Imagine you're playing roulette and only betting on black. There are 38 slots on the wheel, and 18 of them are black. That gives you just over a 47% chance to win on any single spin. You might start playing and hit a nice streak, but this is exactly where gambler's ruin kicks in. Every spin still carries a negative expected value. It doesn't matter how confident you feel. It doesn't matter how disciplined you are. The math doesn't care. A 47% win rate still means a 53% chance to lose, and eventually you will hit a losing streak. That's why casinos don't need to rig the game. They simply wait. Time does the work for them. The longer you play, the closer your losses move from unlikely to likely to unavoidable. Not possible, not probable, inevitable. Losing becomes guaranteed. But before I continue, there's another issue that's gone mainstream recently, and that's online privacy, which brings us to today's sponsor, Incogni. According to the annual data breach report from the ITRC, global data breaches jumped 211% from 2023 to 2024, and these cybercriminals don't pick favorites. They leak phone numbers, financial records, health details, and even social security numbers. Once that data is exposed, it's copied, bundled, and sold through data brokers you've never heard of. That's usually where scams and identity theft begin. Incogni helps lower that risk by removing your personal information from the internet. Their automated system deletes your data from hundreds of known data brokers, and if your information shows up somewhere outside that system, they offer a custom removal option. You just send the link and a dedicated privacy expert takes care of it. Incogni offers a 30-day money-back guarantee, so you can try it risk-free. If you want to regain control of your personal data, head to incogni.com/casualfinance and get 60% off an annual plan. Thanks to Incogni for sponsoring this video and letting me focus on what actually matters, exposing the fine print in finance. So let's get back to gambler's ruin and how prop trading uses it. When you apply this concept to an industry where 93% of participants lose, the outcome is never in your favor. That's the real edge these firms have. They aren't hunting for elite traders. They're waiting for failure. Gambler's ruin doesn't require bad decisions. It only needs time and repetition. And when you combine that math with strict drawdown limits, capped upside, and instant reset failure rules, the ending is already written. From the firm's point of view, this is a volume game. They don't care who passes. They care how many people try. If 300,000 traders attempt to challenge and 279,000 fail, the business works perfectly. In fact, the winners are useful. They're proof of life. They're hope. Firms showcase those rare successes to attract scale, because once the numbers are big enough, gambler's ruin takes over. And once you see it this way, everything clicks. Prop trading isn't about bad traders making mistakes. It's about a system that only survives if most people lose. In prop trading, you're not the customer. You're the input. Your attempts fund the system. Your retries keep it alive, and your rare wins advertise it to the next wave of hopeful traders. So if there's one takeaway from this entire video, it's this: stay as far away from this industry as possible. These companies sell a fantasy and make money from your financial collapse. And if you've heard any trading horror stories from friends, Reddit, or even your own experience, drop them in the comments. The more attention we bring to how this system really works, the more people we can stop from losing money they can't afford to lose. And remember this: sometimes the smartest trade you'll ever make is choosing not to trade at all.